Is the market working just the way it ought to be working given the glut of oil?
Yeah, thank you so much, Tyler. Thank you for having me on. And I think the answer to the question is yes, the market is working, but we may not like it very much. And I think the negative price territory for WTI yesterday illustrated sharply that the storage problem we've all been talking about so much, about the U.S. running out of storage, that problem is already here for the commodity markets. Whether or not the U.S. is technically out of storage now, we can clearly see WTI pricing yesterday as though storage is a very scarce commodity. So I think in a way, this is what the market working looks like. And we saw, I think, the negative pricing yesterday and extremely low pricing today. This is a wake-up call for policymakers, especially folks in D.C. that have been reluctant to act.
In other words, perhaps, Andy, we will stop letting the market function quite the way it has been, and there may be some sort of intervention here. Talk to me a little bit about that. What kind of intervention, if any, might be effective other than a drastic cut in oil production? The oil cut in production agreed to by OPEC a couple of weeks ago hasn't even taken place yet.
Well, that's one of the major problems in the market is just simply so oversupplied here during the month of April that the OPEC action is just too little too late. As far as government action, a number of things have been proposed. We actually did have the Texas Railroad Commission meet today. And what they decided was just to convene a task force to research into the problem that is being experienced in the oil patch. Another thing that has been proposed is limiting the amount of Saudi crude oil coming into the U.S. or imposing tariffs on Saudi crude oil. Well, this would just displace where Saudi crude oil went. Saudi crude oil would then go to Asia or Europe, and the U.S. would backfill with other resources. But what it means is there'd be no change in the overall supply dynamics in the oil market. So really, I agree with your other guest that the market is working. It's telling the producers there's too much oil, you need to cut production. And unfortunately, we're seeing that first here in the U.S. and Canada, but this is going to actually spread to members of OPEC+.
How, Katie, do you cut production as dramatically as it needs to be cut, not just in Saudi Arabia, Russia, within OPEC, but here in the United States? How do you cut production without costing, ultimately, maybe tens of thousands of U.S. jobs?
Yeah, that is such a good question. It's one that we obviously see policymakers struggling with. Just as Andy noted, the Texas Railroad Commission meeting today, and really reluctant, despite a lot of leadership from Commissioner Sitton, to try and push the regulator towards a more aggressive stance, just really reluctant to take that first step in North America or in the U.S. at least, to dial back production administratively. We do think that the U.S. federal government has some authorities and some powers. We've had a lot of discussion around purchases of crude for the Strategic Petroleum Reserve, or purchases of crude actually in the ground, trying to hold back production by paying producers not to produce. We've, certainly talked about tariffs. Tariffs, I agree, are not a fundamental solution and kind of adds insult to injury for our already beleaguered refining sector. But really, we don't have a lot of cohesion in the U.S. I think this illustrates one of the major challenges for the U.S. oil industry. We've got so many different voices, right? So many different interests. So it's hard to kind of pick a path forward.